Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, the market just turned in its best first half since 1998, and so now as we start the second half of 2013, the obvious question is, are we going higher? Is there any more momentum left? We're going to find out from the people who join us this time around at the roundtable, stock strategists Todd Bunton and Brian Bolin, and our market technician, Kevin Matris. Mr. Matris, you say that the overall larger view of the market rally still intact. It's going higher.
Yeah, I mean, the pullback we had seen, I think it was an overreaction to what Bernanke had said about the taper. But the larger term uptrend is still intact. So, yeah, I do believe that we are going higher by year's end.
Okay, Todd, you say there's going to be a lot of back and forth.
I think so, yeah. I see more of a flat market going forward. And I think Bernanke did take a lot of air out of the markets with his comments. And I think it might have been an overreaction to that, but I think you also have to admit that the first 5 months of this year were probably an overreaction to the announcement of QE anyway. So it's kind of a hyper volatile market right now based on what Bernanke said. But now that he's taken that air out of the markets, I think we'll see more of a flat stock market going forward, just awaiting a new catalyst. I think that's kind of the theme for the summer is what's the new catalyst now that people are realizing that QE3 is going to end soon.
But you say the bottom's been put in.
I think so. I think around 1570, which was the old all-time high on the S&P 500, that was a resistance level for a while. Once we broke that, you saw us pull back there and bounce right off. So it does seem to be a decent support level. I'm not the market technician here, but that seems to be kind of where the bottom is.
And remember that. You're not the market.
That's right.
The one thing I do want to say is I'm not convinced that the low is in. We could probably see the previous lows undercut one more time, maybe 15, 25-ish, because if you take a look at it, that's where the longer-term trend line as well as the 200-day moving average come into play. But the longer we don't go down, that moving average and the trend line continue to go up, so maybe that would be 1550 or so.
So, Brian, you say the bottom is in also. That would seem to suggest that there may be some better gains coming in the second half sometime.
Yeah, absolutely. I think you haven't seen any pre-announcements, coming out from any companies for the most part. And the ones that we have seen have been positive. Synaptics, I think, is kind of the one that kind of stands out here. So in the technology chip area, you have that going for you. So I think, the earnings season coming up is going to be a good one, and I think that pushes us higher. This morning, the ISM number came out, and we had a employment component of that suggesting that the Friday number, the jobs number, is going to be very weak. And with the Fed so tied into the unemployment rate, the market's moving higher today just with the anticipation that the QE will continue or at least be sustained for another couple months. So you're going to likely have that low unemployment number.
Yeah, he brings
or
up
high unemployment number.
He brings up a good point, the unemployment number. Now, you say your market's looking for the next catalyst.
Yep.
Is that jobs report that comes out on Friday going to be critical to this rally?
Absolutely. And I still think that, Brian brought up a good point. The market is still kind of framing all of the economic data through the lens of what does this mean for quantitative easing, not what does it mean for the economy and for earnings. So yes, jobs number, always a market mover. That's coming out on Friday. And then as Brian alluded to, we have earnings season right after that as well. So there are a lot of market movers. These could be the catalysts that we're looking for just within the next couple of weeks, so it's exciting times here.
Interestingly enough, earnings season really over the last 3 years has been very beneficial to the market. On average, earnings season, you're seeing the market pick up anywhere from 3 to 5%. I mean, it doesn't hold all of those gains once earnings season ends, but by and large, the earnings season has been a fantastic catalyst and very supportive for the market.
So let me ask you about the second half, as long as you're talking about it.
Okay.
Can the market match second half gains in the second half?
Whether it matches, I don't know, but I would not be surprised to see the market finish above 20% by year's end. I mean, if you were to take a look at really just over the last 20 years, I believe we've closed over 20% my goodness, I think it was like 60% of the time, 65% of the time. So we've had big gains in the past. This has been a spectacularly auspicious start. I have no problem with forecasting those kinds of gains by the end of the year.
But could we get there without QE if QE3 is tapered down?
You know, the perverseness about what we saw with that recent GDP is that you have some traders secretly cheering the weaker GDP because it sends a signal to the Fed, hey, go slow. But even if they do start to taper, they're not talking about killing it off entirely. They're still talking about keeping interest rates low until 2015. This is still a fantastic equities buying environment, and I think that whether they give up on the bond purchases or not, we still have higher equities to come.
You brought up a good point, too. First quarter GDP data was a little disappointing.
Yeah.
Markets seem to ignore it, however.
Right.
You say it's because it's ancient news. But what about economic growth in the second half, Brian?
You know, it's going to be there, but it's going to be small. And I think that's the idea. When you're looking at a market that's so focused on QE, the traders are going to look for that low-hanging fruit. They want to take what's easiest first, and that is the free money that's coming from the federal government in the form of QE and those bond purchases. So when you have something like that, it's like, who cares what the rest of the economy is doing, where the growth is? It doesn't really matter because I know I'm going to get fed every other Tuesday or so from the POMO.
It's an interesting point, too. So you still say everybody, is worried about QE, the end of QE and everything. I've never asked this of a panel here, are any of you guys afraid of QE? Are you worried that the end of QE is going to bring bad things?
No, and I think the bad things we saw kind of already happened. The market seemed to price it in a little bit that it's going to end. I think slowly and surely the market's going to start returning to fundamentals and stop framing everything within the context of, does this mean more QE or not?
Right.
So I think that's a healthy thing for the market to return to actual fundamentals, the economy, the earnings on stocks.
Yeah, the transition is the scary part, but the Fed actually leaving is not going to be the scary thing because, again, the only reason why they would be doing this is because they believe it's no longer needed. So if you remove something that's no longer necessary, it shouldn't have a real negative impact on the market, but how this is done and what the transition looks like, that's where the scariness is.
Brian, give you the last word.
Yeah, I would say it's going to be a difficult time when they say that the taper starts to come in and then when it fully comes off. I think that's going to drive a lot of fear through the markets. The free lunches are gone, and then we're going to have to try to scalp each other. So when you have a system like that, then you run into some more trouble.
And he already took the precaution by getting the haircut.
There we go.
Right.
Before everyone else.
I went to Kevin's barber. He's been very frustrated.
I have not seen him in a long time now.
Thank you all for that. And don't forget, these gents have their top stock picks for this week. That's in our next segment, so you can click on over to it now.